Ladies and gentlemen, this morning the market was hit with a major shock. A brand new jobs report just revealed that the U.S. economy unexpectedly lost 92,000 jobs in February, completely missing expectations of a 58,000 gain. At the same time, the unemployment rate has climbed to 4.4%, signaling that the labor market may be weakening faster than analysts predicted. Meanwhile, oil prices are surging, geopolitical tensions are rising, and risk assets including Bitcoin and XRP are starting to feel the pressure. In this video, we're going to break down exactly what is happening, why the markets reacted so quickly, and what this could mean for crypto, stocks, and the global economy going forward. The latest jobs report delivered a major surprise to the markets when it revealed that the U.S. economy lost 92,000 jobs in February, while economists had expected the economy to add around 58,000 new jobs. This large gap between expectations and reality signals that the labor market may be weakening more than analysts initially predicted. Because employment data is one of the most important indicators of economic health, such a negative surprise immediately raises concerns among investors. Normally, when the economy is strong, businesses hire more workers, unemployment stays low, and consumer spending increases. Job growth usually supports economic expansion because more people earning wages means more money flowing through the economy. However, when job losses occur instead of gains, it can indicate that companies are slowing down hiring, cutting costs, or even laying off workers due to economic uncertainty. This unexpected decline in jobs suggests that the U.S. labor market may be losing momentum, which could signal a broader slowdown in economic activity. If this trend continues in future reports, it may strengthen fears of an economic slowdown or even the possibility of a recession. Financial markets tend to react very quickly to this type of data. Investors closely watch employment reports because they can influence decisions made by the Federal Reserve, particularly when it comes to interest rates. Weak job numbers may increase pressure on the central bank to consider cutting rates in order to support economic growth. Because of this, the February job loss of 92,000 has been viewed as a negative signal for the market, increasing uncertainty and volatility across stocks, commodities, and even the cryptocurrency market as investors try to understand what this means for the broader economy. The unemployment rate has risen to 4.4%, slightly higher than the expected 4.3%, and this small increase is being closely watched by investors and economists. Even though the difference may seem minor, unemployment data is one of the most important indicators used to measure the overall health of the labor market and the economy. When the unemployment rate rises, it usually means that more people are actively looking for jobs but are unable to find work. This can happen when companies slow down hiring, reduce their workforce, or become more cautious due to economic uncertainty. A rising unemployment rate can therefore signal that the labor market is beginning to weaken. In strong economic conditions, unemployment typically remains low because businesses are expanding and hiring more workers. However, when unemployment begins to increase even slightly, it can indicate that economic growth is slowing and that companies are becoming less confident about the future. For financial markets, changes in the unemployment rate are extremely important because they can influence decisions made by the Federal Reserve regarding interest rates and monetary policy. If unemployment continues to rise, it may increase pressure on policymakers to consider cutting interest rates in order to support economic activity and encourage job growth. Overall, the increase of the unemployment rate to 4.4% above expectations adds to concerns that the U.S. labor market may be weakening, which could have broader implications for the economy and financial markets in the months ahead. This report is especially significant because it marks only the second time since 2020 that the U.S. economy has recorded a monthly job loss. Since the economic recovery that followed the pandemic, the labor market has generally been strong, with most months showing steady job growth. Because of that trend, any month that shows a net loss of jobs immediately attracts attention from economists, investors, and policymakers. When a labor market that has been consistently adding jobs suddenly begins to lose them, it can raise concerns that the broader economy may be starting to slow down. Job losses often signal that businesses are becoming more cautious, possibly due to rising costs, weaker demand, or uncertainty about the economic outlook. For many analysts, this rare negative jobs report is seen as an early warning sign. If more months begin to show similar job losses, it could indicate that the economic expansion is losing momentum. A weakening labor market can eventually reduce consumer spending because fewer people are earning stable incomes, and consumer spending is one of the largest drivers of economic growth. Because this is only the second monthly job decline since 2020, the data has sparked growing discussion about the possibility of an economic slowdown. Investors and policymakers will now closely watch upcoming employment reports to determine whether this is just a temporary setback or the beginning of a more serious trend in the labor market. Many market analysts are now arguing that the Federal Reserve should consider cutting interest rates in response to the recent signs of weakness in the labor market and the broader economy. When economic data begins to show slowing job growth, rising unemployment, or declining business activity, investors often expect the central bank to lower interest rates in order to stimulate economic growth. Lower interest rates generally make borrowing cheaper for businesses and consumers. This can encourage companies to invest and hire more workers, while also making it easier for people to take loans for homes, cars, or other major purchases. Because of this, rate cuts are often viewed as a tool that can help support the economy during periods of slowing growth. However, despite these expectations from some analysts, the CME FedWatch tool, which tracks market predictions for Federal Reserve policy decisions, currently suggests that the Fed may choose to pause rather than cut rates at the next meeting. This indicates that many traders believe policymakers might wait for more economic data before making any major changes to interest rates. The Federal Reserve often takes a cautious approach when adjusting monetary policy. Even if some economic indicators appear weak, policymakers usually prefer to analyze multiple reports over time before deciding to cut rates. They must also balance concerns about economic growth with the need to control inflation. As a result, there is currently a growing debate in the financial markets. Some investors believe rate cuts are necessary to support the economy, while others think the Federal Reserve will maintain its current policy stance for now. The decision at the next meeting will therefore be closely watched by investors across stocks, bonds, and the cryptocurrency market, as it could significantly influence market sentiment. The negative economic data did not only affect traditional financial markets, it also had an immediate impact on the cryptocurrency market. After the weak jobs report was released, many investors began moving away from risk assets, which include cryptocurrencies. As a result, prices across the crypto market started to decline. One of the assets affected was XRP, whose price dropped to around 1.35 as selling pressure increased. This decline reflects how sensitive crypto markets can be to major macroeconomic news, especially when the data signals potential weakness in the global economy. At the same time, the largest cryptocurrency, Bitcoin, also experienced a noticeable drop. Bitcoin often acts as a leading indicator for the broader crypto market, meaning that when Bitcoin falls sharply, many other digital assets tend to follow. The sudden decline in Bitcoin's price added further pressure on altcoins, including XRP. When economic uncertainty increases, such as rising unemployment, weak job data, or geopolitical tensions, many investors prefer to move their money into safer assets. This shift can lead to short-term sell-offs in crypto, causing prices to fall quickly. Overall, the weak U.S. economic data triggered a wave of volatility across financial markets, and the cryptocurrency sector was no exception. Both XRP and Bitcoin reacted negatively as traders adjusted their positions and responded to the growing uncertainty in the global economy. Oil prices have recently surged sharply, climbing above $86 per barrel, which marks the highest level since April 2024. This sudden rise in oil prices has attracted significant attention from investors and analysts because energy prices play a major role in the global economy. When oil prices increase rapidly, it usually reflects growing concerns about supply disruptions, geopolitical tensions, or stronger global demand. In this case, the surge is partly being driven by rising geopolitical risks and uncertainty in the global energy market. Any instability in major oil-producing regions can create fears that supply may be reduced, which pushes prices higher. Higher oil prices can also have a direct impact on inflation. Since oil is a key resource used in transportation, manufacturing, and energy production, an increase in its price can raise the cost of goods and services across many industries. Businesses may face higher operating costs, which are often passed on to consumers in the form of higher prices. For financial markets, rising oil prices can create additional pressure on the economy. If energy costs remain high for an extended period, it can slow economic growth and reduce consumer spending. This is one reason why investors carefully monitor movements in the oil market. The fact that oil has now crossed $86 per barrel for the first time since April 2024 suggests that the energy market is entering a period of increased volatility. Analysts will continue to watch whether prices stabilize or move even higher, as further increases could have significant effects on inflation, economic growth, and global financial markets.